RIN TV coverage of the 2015 European Insurance Forum is brought to you by the Dublin International Insurance and Management Association. So it appears the level of demand for insurance has peaked and is even declining in Western developed economies. What's behind the downward trend? We asked Enda Murphy, EVP and Head of Global Business Operations at RGA International Reinsurance, for some answers during the European Insurance Forum. Here's what he had to say.
Well, over the last 10 years, the proportion of GDP that protection insurance takes up in all the major markets has declined, other than Asia. In the US, where GDP has grown by about 17% over the last 10 years, our percentage of GDP has dropped from about 1.9% to 1.6%. Similarly in the UK, similarly in continental Europe. In fact, it can be most summed up by a statistics taken from the Geneva Association Report that shows that the number of households in the US that had protection insurance 10 years ago was about 64%. In 2013, that had dropped to about 42%. So it shows our position in the market is dropping. Some of this is attributed to the economic trend. Banks aren't lending as much. The economic crisis has caused companies to focus inwardly rather than outwardly at their customers. But there's two key things that are very important in it. One is the new solvency regulations. Regulators have forced us in the industry, and with good reason at times, to look at our own solvency and how we manage ourselves. That forces us to take our mind off what our ultimate customer needs. And every time we change the solvency requirements, it's increasing the price of the ultimate product to the consumer. The other issue is that regulations, again, sometimes with good reason, have made it difficult for direct sales forces to operate. Insurance is sold, not bought. So if you don't have a direct sales force, it's one means of access to the consumer, which is not available to us anymore. The average age in the US of the direct sales force has grown from something like 42 10 years ago to about 54 today. Shows the aging distribution of our direct sales force and the more limited access we have to consumers. Well, the economic recession for almost all governments has forced them to look at their taxation policy and their social welfare policy. The consequence of there being an insurance gap is that that economic burden falls back on the state. The state then has to look and say, either we increase taxation or we decrease our benefits. That's not a nice place for any policy maker to be. It's only by the two of us working together that we can fill the gap. Well, the most important thing is that we recognize what's happening. We need then to get regulators, the industry, but most importantly, policymakers who are part of government to recognize what is happening. Some years ago, here in Ireland, about 15 years ago, the government recognized that there was a pension gap, and they started to put money aside to fill that gap. Now, the economic recession hit and we had to spend that pot of gold, but we need to think the same way about the insurance gap. We need to work with governments to create incentives for people to buy their own insurance and make sure they are self-sufficient. The one place where there is a complete change, reversal of the trend, is actually in Asia. If you exclude Japan, even though their economy had relatively low growth for the last number of years, actually the level of protection in Japan has stayed quite high. In Asia, it is growing. That's partly because you bring China into the equation and it's just dramatically changed the whole market. The other markets in Asia are just the economic development level is such that the level of market penetration for insurance products has grown. Otherwise, throughout the world, it is the same trend has been recognized.
For more of our coverage of the 2015 European Insurance Forum, visit the DEMA website or the special 2015 EIF channel in the RIN TV On Demand library.